My name is Michael King, and in this video we're going to be looking at capital budgeting when you have multiple projects. In the first, we're going to look at independent and interdependent projects. This is going to be section 13.3 out of Booth, Cleary, and Rikita. And recall that we've been talking about net present value, where net present value is the sum of the present value of all the future after-tax and incremental cash flows minus the initial investment. And in this formula, we can see that the future cash flows come at different periods in time, from time 1 to time n, and that the upfront investment is shown as cash flow 0. K would be the discount rate, and typically the discount rate we'd be using would be related to the weighted average cost of capital, adjusted for the riskiness of a project. The rule is that if the present value of the cash flows is greater than the upfront cost, that is going to generate a positive NPV, and with a positive NPV, we just want to do the project. Now this is obviously simplistic because it assumes that we have unlimited capital to pursue multiple different projects that may have positive NPVs. We also spoke about internal rate of return, or IRR, and recall that this is simply the discount rate that would actually set the NPV equal to 0. So in this formula, you're just solving or iterating for the discount rate K such that the NPV equals to 0. Notice that NPV is focusing on after-tax incremental cash flows, and it ignores sunk costs. So what do we mean by those two things? Well, incremental cash flows or costs are ones that will change based on whether we go ahead with the project or not. And notice that we want to focus on the after-tax incremental costs as well as cash flows. Sunk costs, however, are past investments that are unrelated to a current project and that will not go away or disappear if the project doesn't happen. So the rule is that we don't consider sunk costs when looking at a new project. Now what happens if you have multiple projects? Well, we have to look at some terminology. Projects may be independent or interdependent. Independent projects are ones that have no relationship with one another, which means that accepting one project will have no effect on whether you accept other projects. The rule in this case is that all independent projects with positive NPV should be accepted subject to the budget constraint. Interdependent projects are projects that are related such that accepting or rejecting one has an impact on the value of other projects. There are two different types of interdependent projects, which we're going to call mutually exclusive and contingent. So what's the difference? Well, mutually exclusive means you cannot choose both. You're forced to choose one or the other. The rule is just choose the one with the highest NPV when they're mutually exclusive. But a contingent project is a project where it's a bundle. You have to accept one in order to accept the others because they build on each other. And a classic example is that you have to invest in a rail network, which may be an upfront cost and a negative NPV project, before you can make money by investing in rail cars for shipping, which could generate a positive NPV. Similarly, in today's day and age, you typically have to buy computers and an operating system before you start up a company, a tech company, where you want to develop software or an app. So there's going to be some upfront or negative NPV project prior to doing the positive NPV. The rule is going to be that you look at the NPV of all the projects that are contingent together and accept them if overall or in sum they generate a positive NPV, or you reject them altogether. Typically what happens with the company is that we have a problem called the budget constraint, where capital is constrained or rationed. What this means is that the company has more projects that they could invest in any one year than capital available, and so they have to look at all the positive NPV projects and see which ones to choose among. Now recall that the different riskiness of the projects has already been reflected in the discount rate, which is going to be a modification of the weighted average cost of capital. More risky projects than the average have a higher discount rate, less risky projects have a lower discount rate. With that in mind, one of the tools we looked at was profitability index, where you simply look at the sum of all the cash inflows in present value terms divided by the upfront cost. In other words, it ranks PV for every $1 of capex. The problem with this profitability index is that it doesn't have a dollar value, it's simply an index, and it may not provide a solution when you have projects that have different lives. So the rule that we're going to focus on is choose the combination of projects that will generate the highest total NPV and fit within the budget constraint. But what happens when you have projects that have actually different lives? So there's two approaches that are typically used. The textbook will look at both. The first one is called the chain replication approach, and we're going to ignore that one because the one we want you to focus on is called Equivalent Annual NPV. Here, we're simply going to look at projects with different lives and compare them by expressing them as payments on an annuity. So what we're going to do is we're going to calculate the NPV of each project using its risk-adjusted discount rate. And then we're going to back out what payment on an ordinary annuity would generate that NPV over the life of the project. So let's take a look at the formula. Here you can see we have the NPV in the numerator or the top of the formula, and we have that present value of the annuity in the bottom. And what we're solving for effectively is the payment on an annuity. So let's go back and look at an ordinary annuity. So remember that this was the formula for an ordinary annuity, where the price today, the PV0, was the function of the payment, which is fixed over the life, discounted to today at some discount rate, where you have regular payments over some fixed life. Now rearranging this, we saw that you could solve for the payment. That would lead to the present value of the annuity if you were given the discount rate and the number of periods. All we're saying here is that the equivalent annual NPV is the same form as this payment. Notice that it is the NPV instead of the PV in the top of this form of this ratio, and the bottom is the same. So with the equivalent annual NPV, we simply find the payment on an ordinary annuity that will generate the NPV of the project. How do we do this? Well, we have to have a discount rate, which was used to generate the NPV on the project. We have to have a present value, which is the NPV. We're going to treat the future value as 0, meaning there's no salvage value. It's already incorporated into the NPV calculation. We know the life of the project, which is the number of periods or years n, and we're going to use end period discounting. And all we do is solve for payment, which is going to give us this equivalent annual NPV. So let's look at an example. Okay, so we have two mutually exclusive projects. Project A is going to cost $50 up front, generate $30 in year 1, $40 in year 2, and the discount rate is 10%. Project B also costs $50 up front, but it generates $25 each year for 3 years, also with a 10% discount rate. So drawing them on a timeline, here's what the cash flows look like. Here are the cash flows for Project A and the cash flows for Project B. Notice that they have different lives. Well, if you were to calculate the NPV using this discount rate, you would find Project A has an NPV of 10.33 and Project B has an NPV of 12.17. So if you simply went by the NPV, you would choose Project B. The problem is that Project B is generating $25 each period for 3 periods, and it's hard to know if that $75 over 3 periods is larger or smaller in present value terms than the $70 generated by Project A. So what we're going to do is we're going to calculate the equivalent annual NPV for each project. Okay, so for Project A, notice that it is 2 periods. It's discounted at 10%. We take the NPV of 10.33. Solving for the payment, we find that the equivalent annual NPV is 5.95. For Project B, we see that we have 3 periods, discount rate of 10%. The NPV is 12.17. In solving, we get that the payment each period is 4.89. Now we can see that we want to choose the project with a higher equivalent annual NPV, which is going to be Project A. And what this illustrates is that NPV itself can be misleading when projects have different lives.